Look around you. So much of our modern world is new. New ideas, new buildings, new narratives. And that's great. Change is necessary for progress. The whole world gets it. So how is it possible that despite all this progress, we still learn in the exact same way our grandparents did? Our education is evolving so slowly. But why? What if your education could evolve and improve as quickly as the world around us does? What if your education was designed to help you discover who you really are? If students were created like co-creators instead of just products? If there was a space meant to build connections between teachers and students? A place where safe space doesn't mean you'll be shielded by censorship. Where liberty isn't just what you learn, but how. Your education should keep up with the rest of the world. And now, it can.
Good afternoon. My name is Olaf Dirkmaat. I'm director of the Public Choice Center, CADEP, of Universidad Francisco Marroquín, on behalf of the Centro Henry Hazlitt de la misma universidad en Guatemala. I would like to welcome you to this conference. The conference is titled Bitcoin in El Salvador, have the neighbors gone crazy? So that's the question we will answer today. In this conference, we are going to discuss the pros and cons of implementing Bitcoin in a Central American country such as El Salvador, and we might discuss briefly the impact on Guatemala. As an introduction, I want to give some context about El Salvador and this law. El Salvador is a small country in Central America with a population of 6.5 million people. Since 2001, its legal currency has been the US dollar. Its GDP per capita, that's in a purchasing power parity terms, is $8,500 per capita. And according to the World Bank, approximately 2.2 million Salvadoranians, 34% of the population has access to internet with different kinds of devices that would include cell phones. Also, according to the World Bank global financial inclusion data, approximately 70% of its population does not have a bank account. So that's a very similar situation as with other Central American countries such as Guatemala. Only 5.7% of the population has a credit card, 5.6% of the population purchases or pays bills online, and 3.5% of the population has a mobile money account. On June 5, very recently, in a recorded announcement played at the Bitcoin 2021 conference, the president of El Salvador, Bukele, announced that its country will declare Bitcoin as legal tender. The Salvadorian Congress, received the bill next week or a week later, and on June 9, the Congress approved the bill that will come into effect on September 7. The Bitcoin law has led to many questions and many doubts, and there are several articles that actually contribute to our doubts and questions about this law. Because it appears to make Bitcoin a legal tender, but in its most strict sense possible. Specifically, in Article 7 of the law, it says every economic agent must accept Bitcoin as payment when offered to him by whoever acquires a good or service. In other words, Bitcoin is not to be just a legal tender in El Salvador, but it is forced, or is used as forced upon every merchant in El Salvador. On the other hand, Article 12 in the same law establishes that those who, by evident and notorious fact, that's the language used in the law, people that do not have access to the technologies that allow them to carry out transactions in Bitcoin are excluded from this obligation, are excluded from this legal tender imposed by the Salvadoran government. So many technical questions are yet to be answered, and before September 7, because on September 7, we have the full enactment of the law, and there are many doubts and many issues to be resolved. And until then, we will have to see how Salvadoran authorities will cope with those doubts and questions. No, as the clock keeps ticking, El Salvador is about to make. Is the first country in the world who is going to make Bitcoin legal tender. And with that in mind, we should ask ourselves, why is El Salvador adopting Bitcoin? Does this law collide with economic freedom and the freedom of contract? What effects and what consequences will it have for the region and for the country? Can a country use Bitcoin as well as the dollar as legal currencies or legal tender at the same time? And indeed, we could summarize all this in one easy question: Bitcoin in El Salvador, have the neighbors gone crazy? To discuss those and other questions, we have here our guest, George Selgin. George is a senior fellow and director of the Center for Monetary and Financial Alternatives at the Cato Institute and professor of economics at the University of Georgia. His research covers a broad range of topics within the field of monetary economics, including monetary history, macroeconomic theory, and the history of monetary thought. Selgin holds a BA in economics and zoology from Drew University and a PhD in economics from New York University. And myself, I use one of his books. I think he published it in '88. The Theory of Free Banking, and many of our classes at Universidad Francisco Marroquín. So I would like to welcome George, and I would also like to invite you all watching this conference to write your questions in this conference post in Facebook, as well as on other platforms like YouTube, where we might be live at the moment. And please share all your questions with us, and we would answer those and discuss those questions at the Q&A at the end of the conference. So, George, thank you very much for your presence. Welcome, and the floor is all yours.
Thank you, Olav. It's a pleasure to be speaking with your students and others at Francisco Marroquín. I only wish I could be down there, as I have been in the past, but these days, of course, those visits are a little bit harder to arrange. Anyway, I'm delighted to be able to be speaking here tonight on a topic that should be of great interest to students at Francisco Marroquín, particularly since this is part of the Hayekian program down there. It's very relevant to that program, I should say. So I would like to start by talking about the fact that Bitcoin, in its origins, certainly, but also very much in its later development, has been understood as a Hayekian phenomenon. As I think many of the people listening to me now know, Hayek wrote a very radical pamphlet in 1974 called, or was it 76? Pardon me, I'm not sure which on the spot, but called Choice in Currency, where he argued against government money monopolies and for free competition in currencies. He later expanded that into a longer pamphlet called Denationalization of Money. And there he put forward the even more radical idea that private firms should be allowed to compete with governments, and not just by issuing redeemable or convertible substitutes for existing government monies, as banks already did to some extent, and as they did even with paper money in the past. But he proposed that private firms might issue their own fiat type monies, that is, inconvertible monies, representing entirely new monetary standards, but with no government involvement or support whatsoever. Now, I confess that at the time these pamphlets came out, and for some years afterwards, I, along with others, was very skeptical about the idea that a private inconvertible money could ever take off. After all, most government inconvertible or fiat monies were imposed on people. That's the only reason they gained widespread use. People didn't have much choice. And we're going to be talking about the kinds of laws used to force people to accept fiat monies in the past later on in my discussion. Well, it turns out that many years later, something like an inconvertible private money did arise, and now there are quite a few of them. But the original one was, of course, Bitcoin. Bitcoin is a unique monetary standard, an entirely private, decentralized kind of money, or at least something that aspires to be money. It is certainly a medium of exchange. And so, lo and behold, in a technological form that, of course, neither Hayek nor anybody else back in the 70s or for some years later could have anticipated, his idea of private currency competition was given a concrete manifestation. It became real, and it's very real now. So looked at that way, Bitcoin was a remarkable achievement, a remarkable Hayekian achievement. And as such, it was meant to be a rival to government currencies, not a government currency or official currency itself, but something people could resort to as a way of not having to use official currencies, and resort to, of course, entirely voluntarily, for otherwise that would hardly be consistent with Hayek's idea of free choice in currency for anybody to be forced to use any private fiat money, just as it's inconsistent with that ideal for them to be forced to use any government currency. Bitcoin made remarkable achievements, not only by catching on, but by catching on in a huge way. Everybody all young people certainly understand just how big Bitcoin is, a huge market share, and gaining every day more and more attention, some of it rather unfriendly attention from government authorities, but gaining more and more attention. El Salvador's move earlier this year was a rare example of a government paying attention, not only paying attention to Bitcoin, but making a concerted effort to jump on the Bitcoin bandwagon, as it were, to embrace Bitcoin and indeed to make it its official money, which is something that I'm sure nobody thought would happen even a year or two before. So this is a remarkable step for Bitcoin. It's a coup in ways. It's a symbol of just how seriously Bitcoin is being taken. However, El Salvador's Bitcoin law is also, in many ways, I'll argue, very contrary to the original Hayekian spirit that first gave rise to Bitcoin. And that's what I want to talk about. I want to talk about the fact that the Bitcoin law that is now slated to make Bitcoin El Salvador's official money come September, when its various provisions will come into effect, is also, unfortunately, a law that is very un-Hayekian in important respects. And it's for that reason that it's controversial. Now, as Olev pointed out, before today and since 2001, El Salvador has been on a US dollar standard. US dollars are the unit of the US dollar is the unit of account. It's how prices are expressed, and it's also US dollars are the actual means of payment. And as Olev also pointed out, many people in El Salvador are unbanked, which means that it's actually not digital US dollars, but actual physical paper US dollars that are the preferred medium of exchange for many transactions there. Now, the Bitcoin law the dollarization law of 2001 was itself, I should say, kind of passed in a hurry. At the time, El Salvador wasn't going through any kind of inflationary crisis. Its established currency the colon was not depreciating rapidly. It had depreciated a lot some time before, but at the time of the new law being passed, it was not depreciating rapidly. So there was no emergency. There was not a lot of spontaneous dollarization. So the case for dollarization was not as strong as its proponents thought. And it must be said that that law was rushed through Congress in El Salvador fairly quickly, though by quickly I mean after some months. It was a surprise bit of legislation when it was introduced. It had been kept secret by then, but then there were a few months before the before the Legislative Assembly voted to pass the law. So this is quite in contrast with what happened this June. This June, what became the Bitcoin law came as a complete surprise. It was first revealed by Bukele in a video played not before any Salvadoran audience, but at the big Bitcoin conference in Miami, which is a kind of unusual way to introduce a new law or to announce it to your citizens. And within days, with hardly any debate or discussion, the Legislative Assembly passed it. So even compared to what happened in 2001, I think it's fair to say that this was quite a rushed piece of legislation. Moreover, it's a piece of legislation that contains an element, a component that is absent from the old dollarization law and is much more un-Hayekian than anything in that law. And that is Article 7 of the Bitcoin law. The Bitcoin law contains a score of articles, that's 20 or so, and they cover various aspects of the requirements or obligations people have when it comes to what they can use for payments, etc., and what the government plans to do. But the one that really stands out, in my opinion, and the one that I'm saying is very un-Hayekian, is Article 7. Article 7 is the one that makes Bitcoin not just legal tender in the usual sense, and I'll explain what I mean by that in a moment, but compulsory tender. That is, merchants, although they're still expected to price their goods in US dollars. The new law doesn't contemplate changing the unit in which prices are expressed or the unit of account, but they are required to accept Bitcoin in payment for their goods at whatever the going dollar Bitcoin, US dollar Bitcoin exchange rate is. That's the requirement. Now, as Olav mentioned, at first that requirement isn't imposed on everyone, nor could it be, since a lot of people don't have access to the internet or don't have cell phones or otherwise are not equipped to obey that law. But those who are will immediately in September be required to accept payment in Bitcoin, whether they'd rather be paid in dollars or not. And eventually, I'll say more about this later, eventually the idea is that everybody should accept payment in Bitcoin. That's Article 13. Again, you don't have a choice. Article 13 is not a typical legal tender law. Most legal tender laws, our own here in the United States, for example, and the legal tender law that pertains to the US dollar in El Salvador today, only requires that dollars be accepted in payment of outstanding debt. So if you owe somebody a certain amount of dollars according to some past contractual obligation, and they give you dollars, what are the dollars that, at least whatever dollars are called legal tender dollars, in the appropriate amount called for by the contract, the legal tender law says, that's it. You've paid your dues. You're done. That's all it says. So it's relevant for outstanding contracts. It settles in a fairly straightforward way what it means to have resolved to have paid one's obligations. But these ordinary legal tender laws say nothing about what merchants, sellers have to accept in payment in what are called spot transactions. That is, transactions happening on the spot. There's no outstanding debt. So, for example, I could go to a restaurant today in the United States and offer to pay US dollars for my meal, but they don't have to accept cash. They don't have to accept paper dollars, which are legal tender. They can say, sorry, we're a non-cash business, you know, COVID and all that. We only take debit cards. Furthermore, if someone wanted to start a Bitcoin-only business in the United States, where they refused any sort of dollars, it would be perfectly legal. Probably wouldn't be very smart because they'd lose some customers, but it would be perfectly legal. So that's how most legal tender laws work. There are exceptions to this. Almost all of them are countries that where Napoleon spread the so-called Napoleonic Code back in the early 19th century. And some of these do have compulsory tender laws. However, those laws, at least now, make it compulsory for people to accept what are already well-established monies in those countries, like the Swiss franc. A merchant in Switzerland can't refuse Swiss francs. But that's not so bad because merchants in Switzerland don't want anything other than Swiss francs. It's when you use a compulsory tender law to force people to accept a new kind of currency that they aren't already accepting and they don't want, that it becomes something obnoxious. As it was, for example, in revolutionary France, when they first made people accept paper money that people didn't want. And in that case, the penalty was ultimately raised to death for refusing to accept paper or insisting on payment in gold or silver. So these laws can get very un-Hayekian indeed. Now, the new Bitcoin law does include a traditional or standard legal tender clause, which is Article 13. But it's Article 7, that's the compulsory tender law. That's the controversial one. That's the one that I think that is very un-Hayekian and is a bad idea. Now, I should say, it's not just that it's a bad idea from a Hayekian or philosophical perspective. It's a bad idea, in my opinion, because it's going to hurt people. It's going to harm people instead of helping them by imposing costs. The fact of the matter is that as much enthusiasm as there is for Bitcoin, and as much as its importance has increased over the last decade, it's still not a popular medium of exchange for most purposes. The vast majority of people never deal in Bitcoin at all, and that's been true for the people of El Salvador as well. Yes, there was an experiment, there's been one on the place now known as Bitcoin Beach, where subsidized Bitcoin transacting has taken place, and they've made great efforts to encourage people to use Bitcoin. But the fact of the matter is that the vast majority of Salvadorans don't use Bitcoin, and they don't want to use it. There was a poll taken soon after the passage of the Bitcoin law by the Salvadoran Chamber of Commerce, asking people, different kinds of people, whether they would rather be paid in Bitcoin or in dollars, asking them whether they'd rather have remittances in Bitcoin or dollars, and so on. And the responses to these questions, which were responses from large numbers of people, this was not a small sample, overwhelmingly showed a preference for payment in dollars, not Bitcoin. So the first thing to understand in trying to grasp whether this measure is really going to make people better off or not is that it isn't popular. It's not popular. That begs the question, how come this law got passed? But if you know the politics of El Salvador at all, you probably know that two of the major political parties are solidly behind Bukele. So it was sufficient for them to support the law, for the deputies belonging to those parties to support the law, for it to get through without much discussion. And that's what happened. But this is not a popular law according to the polls. And it can harm people because making people accept Bitcoin, dealing in Bitcoin, I should say, by anybody is risky. I don't think I need to tell this audience that Bitcoin is an extremely volatile asset. That is one whose value against dollars particularly fluctuates tremendously and can fluctuate a lot in a very short period of time. Why only during the weeks after the Bitcoin law was passed, some remarkable examples of these fluctuations took place, showing just how volatile Bitcoin could be. Now, what's wrong with that? Well, when people are forced to deal with Bitcoin, usually that means they're forced to hold on to it for some period of time. And in an incredibly volatile market where the price can change quickly, that could mean that they have to bear substantial capital gains and losses. Now, as we'll see, that's not quite how the new Bitcoin law works. So maybe I should turn to the way in which this risk is dealt with by the law before I explain why I still don't think the law is harmless. So there are actually two things about Article 7, or two aspects of the Bitcoin law, two sets of provisions that have been pointed to by apologists for the law to say that Article 7 isn't really all that bad and doesn't really hurt anybody. First, they point out something that Olev already said. Those who aren't equipped to accept Bitcoin don't have to accept it, which is only reasonable. So the law is not applicable to everybody. And that's true, at least for now. But that's not really a justification for the law. It means that if the law is obnoxious, it's not as obnoxious because not everybody has to abide by it. But if you look carefully at the other provisions of the Bitcoin law, it's very clear that they're intended to make sure that eventually everybody has to and can use Bitcoin, can accept it. So the idea is to get all merchants eventually accepting Bitcoin by improving the internet, by making free software available, government wallets, by having a lot of ATM machines. So the idea is to make it technically possible for this to be a universal law. In that case, of course, the fact that people will temporarily, some people won't be required to abide by it is not always going to be relevant. But the more important argument that apologists for Article 7 make is that the people who have to accept Bitcoin aren't really going to have to assume the risk because the government's going to arrange for them to be able, if they wish to instantly convert Bitcoin that they receive into US dollars. And that's true. The government is, as they put it, assuming the risk of that's associated with accepting Bitcoin because it's offering to pay merchants dollars at the dollar rate they would have gotten if they'd been paid in dollars in the first place, and notwithstanding any change in Bitcoin's market value between the time the trade took place and the time the government exchanges dollars for merchants' Bitcoin holdings. So the government's going to assume that risk, but let's be careful. I think with students at Francisco Marroquin, I may not have to belabor this point. The fact is that governments never assume risk. They can only shift it to other people. And that's exactly what the Bitcoin law does. It sets up a special Casa del Cambio at one of the banks of El Salvador. And that Casa del Cambio is equipped with an initial fund of $150 million, which is going to be invested in Bitcoin. And out of that fund, the government will cover any change in the value of Bitcoin. It could lose money if it ends up paying out dollars for Bitcoin when the Bitcoin are falling in value. It could gain money. It could appreciate. Its fund could grow if it gets Bitcoin and Bitcoin's price is going up. But here's the problem. Merchants are mostly going to want to convert their Bitcoins into dollars when they're pretty sure that Bitcoin's price is going down. That is, more of them are going to want to convert. And fewer are going to want to convert if they think Bitcoin's going to go up. So what's going to happen? Well, what's going to happen is you get a lot of conversions at a time when the price of Bitcoin is falling, not so many when it's rising. Eventually, the fund that's behind the Bitcoin conversion apparatus gets drained, and taxpayers will have to replenish it. They already have to pay for the initial amount. So ultimately, the risk is being passed down from the merchants who have to accept Bitcoin to other persons, taxpayers generally, who end up having to fork up the money to cover the costs of keeping it convertible into US dollars. And those may be even poorer people than the ones who have to accept Bitcoin in the first place. So this is not an arrangement that's friendly for the people who can least afford to take risks. All right, I'm going to close up relatively quickly by saying something about what I think would be a good Bitcoin law. I like many of the components of El Salvador's Bitcoin law, particularly those that are designed to put Bitcoin on a level playing field with the US dollar, which is still at present El Salvador's official currency, but also with any other currency. And many components of the law do that. For example, unlike the United States, El Salvador is no longer going to treat Bitcoin as a commodity and tax it accordingly, tax capital gains. It's wiping out any tax on capital gains, is going to treat Bitcoin the way it treats dollars, as currency. And that's good because it puts dollars and Bitcoin on a level playing field. I'm in favor of that. I'm also, and that's a very Hayekian law. That's good. That's choice in currency, better choice. I'm also in favor of those aspects of the law that would try to improve the internet, of course, but also help people learn how to use Bitcoin, perhaps subsidize the Bitcoin use by providing them with cell phones or with free apps. I don't find those aspects of the law obnoxious at all because people still would have a choice. They would be helped to use Bitcoin, to accept it, but they wouldn't have to. And I think that's the way it should be. So it's really only certain components of the Bitcoin law that I'm opposed to. However, it must be said, and I'm going to wrap up soon, I promise, that if the law were modified the way I would like to see it modified, if you dropped Article 7 particularly, well, it would be more Hayekian, but it probably wouldn't do what Bukele wants to do. That is, it probably wouldn't result in Bitcoin becoming the main medium of exchange or money of El Salvador. It just wouldn't do that. In all probability, most transacting would continue to be done in dollars. And that raises, of course, an obvious question. Just what is it that Bukele hoped to achieve or hopes to achieve by making Bitcoin El Salvador's money? And what sacrifice would be involved if the law were changed so that probably won't happen? Well, in my opinion, there isn't much good that's going to come out of making Bitcoin El Salvador's money. For reasons I've already suggested, it's not a particularly good money. I wish it were, but it's not. It's highly volatile. Its inherent properties are such that it probably will always be volatile, even if it's widely adopted. Remember that eventually the supply of Bitcoins will cease growing when it approaches 21 million coins. That's not really a recipe for a stable monetary unit. Even under the gold standard, we never had a case where the supply of gold wasn't growing. It grew at a modest rate. It didn't pose the risks of an explosive growth that fiat money can pose. But it grew. It grew. And if it hadn't grown, probably deflationary pressures would have been very serious. As it is, we had serious bouts of deflation under the gold standard, and they weren't any fun. So I don't think this is a very good money. It's certainly not a popular money. Well, so what was Bukele trying to achieve? I think he's sincere, first of all. But as far as I can tell, the one big thing he's hoping to achieve is independence of the dollar. Independence, the idea that El Salvador won't be just one more country that's dependent on the good behavior of the Federal Reserve and cooperation from American monetary authorities to have a reliable medium of exchange. And I understand that. But quite frankly, Bitcoin is going to Bitcoin seems to me jumping out of the frying pan and into the fire, in that there are risks associated with continuing to use the US dollar. There's no question about it. It's not a perfect currency by any means. But the risks are relatively small compared to those of forcing Bitcoin on one's people. There is one particular risk that deserves attention, which is the risk that there won't be an adequate supply of paper dollars from the United States. That could happen if the government tried to suppress shipments of those dollars, but they could fix that pretty easily in El Salvador by creating a currency board that issues its own dollars 100% backed by US dollar assets. Then there would be no need for paper money. Well, I'm told it's time for me to wrap up. I'm sorry if I went a little bit over, but I pretty much said all I want to say, and so I look forward to us having a good discussion about it. Thanks a lot.
So, well, I basically agree with everything George said. So it's very difficult to add something, but I'll try to add something to the perspective of what is happening in Salvador. And I would like to also mention the fact, well, George explained that money supply or the gold supply increased every year by 1 or 2% of total supply. And that's basically what has been happening forever. Whereas the rate of increase of the Bitcoin supply is gradually falling and will reach zero at one point in time. But one of the main differences that really surprised me between Bitcoin and gold is that gold exists without miners. But in fact, the opposite is not true. Bitcoin does not exist without its miners, because without the nodes updating the ledger, the distributed ledger of Bitcoin, there is no Bitcoin. So in fact, this has led to I think a very well versed author, Nassim Taleb, explained that if it is true that in one point in time, the value of Bitcoin is zero because of the design of the protocol, it might be unsustainable in the sense that miners do not reach a certain level of profitability in the future, which means that transaction costs go up exponentially, or it means that transaction costs go up exponentially, or it means that they lose their business model and their interest in mining. It could actually lead to the devastation of the protocol, the devastation of the distributed ledger. It's no longer updated, and without ledger, there is no Bitcoin. And if the future value of something is zero, then we all know, who studied finance, that the present value per definition also has to be zero. So that's a very interesting take, and I'll try to add something to this perspective right now. I'm not sure if I can share the screen, or should I? Thank you. Well, just give some background as in where Bitcoin comes from. And I want to emphasize something about what is happening in Salvador and why in El Salvador they're actually not wanting to exchange Bitcoins, because the transaction cost of exchanging Bitcoins on the Bitcoin blockchain is actually very high, and it is too high for daily transactions. And it actually doesn't confirm, it doesn't go well, it is not well aligned with the original vision perhaps of what Bitcoin ought to be. And Bitcoin, what the reason behind Bitcoin is that it could serve as some kind of gold, as some kind of base of the pyramid of a monetary system that is much more than just Bitcoin. So we'll get there in a second. I think the historical context is important. I think many of the creators or possible creators of Bitcoin have some type of background outside the United States. So their prime memory was probably their parents suffering from some type of hyperinflation in their parents' home countries, which were typically the reason why they had to migrate anyway. So they have in mind that government is able to destroy the value of a currency, and therefore, at all costs, you have to eliminate the possibility of a government destroying the value of a currency. And they took this lesson very seriously. And I think with the predecessor of Bitcoin, which was actually called BitGold, which it suggests that it's completely based on trying to imitate in a virtual world the characteristics of gold as money. I think it suggests that they always have this fear of government meddling with money, with the value of money, and the social consequences that this meddling could have. And I totally agree in a sense. No, we have seen a lot of episodes, historical episodes, where the destruction of the value of money can be very, very devastating for a society. So they always talk about this term, which is trusted third parties are security holes, or as security holes. So what does this mean? Well, in any case, in any banking sector, you always depend on some kind of third party. So whenever, let's say, John buys something from Joe and he buys it in US dollars, there is a third party involved, which in this case is the Federal Reserve, who we suppose is in charge of maintaining price stability of that very currency. If they fail in their mission, they as a third party are a security hole in that transaction. But of course, the security holes are even worse. When we think about banks, and we have seen in history, many banks fail and default. As soon as a bank defaults, they could be a security hole, and they could put at risk the savings of a bank depositor. And therefore, in some sense, banking is based on trust. And one of the intentions, or original intentions of Bitcoin, is to eliminate trust in those very sectors. So the design of Bitcoin is based on that. But trying to make everything as well designed and secured against those trusted third parties or counterparty risk comes at a cost. And the cost is that Bitcoin is very much unable to scale, which means that it's not able to do the kind of transactions a MasterCard or Visa would do on a daily basis. It is impossible to, as the protocol is, have the volume of transactions that we generally need as a population or the country. So even in a small country as in Salvador, probably the protocol in such is not able to process the many payments, like exchanges of a small coffee or some grocery shopping. It wouldn't be able to. They wouldn't be able to do that very efficiently. And that's where second and third layer solutions come into play. So in fact, if we remember that very sentence, third-party risks, or third-party risk is a possible security hole. We see this tweet, which was actually one of the invitees to the university, Nick Szabo, tweeted this. Well, actually, the Bitcoin protocol is very secure, and there has been one breach in over 10 years that Bitcoin has existed. There's been one breach, and the cost of the breach was more or less $30,000. So that's almost nothing when we compare it to losses, for instance, in the traditional banking system due to hacking and other involvement by third parties or undesirable third parties. But there are a lot of people who lost money with Bitcoin exchanges, who are like third parties, who are intermediaries on top of the very Bitcoin protocol. And we know a lot of people lost money with the robbery or the amount lost, the money lost at Mt. Gox, which was in Japan, but also other cryptocurrency exchanges where money got lost because those very exchanges were security holes in the same language. So in a sense, Bitcoin is very secure, but the layers on top of Bitcoin are very insecure. So in one sense, once upon a time, gold was the base of the monetary pyramid. And we had all kinds of different monies that could be converted at some time into gold. And those would be more or would have a higher degree of third-party risk or counterparty risk. So if my bank goes broke or defaults, well, I probably lose my money. But gold as a tangible thing, well, if I have it, it's not a debt of anybody. I just have it. It's an asset for me. It's a debt to nobody else. And if it's physically, if it's tangible and physical, and I can protect it, well, if I have it, I have it. It's not affected by third parties. So gold was at the pyramid, and the idea is that Bitcoin would serve in a new monetary system as well as the bottom of this monetary pyramid. And gold, as well as Bitcoin, was designed to prioritize security over scalability or handling a lot of transactions. So I think one of the misunderstandings with gold and how Bitcoin was designed to imitate, in a certain sense, gold. We all know Bitcoin has a limited quantity, a limited supply, and in some sense, they copied that idea of gold, which naturally is scarce. But I think there's a big misunderstanding of the gold market. The gold market is actually two gold markets, one monetary gold market and one non-monetary gold market, and they both function in a parallel way. That means that whenever people demand more money or would demand more gold as money, money from the non-monetary gold market would flow in and would increase the supply of monetary gold, as well as vice versa. If the demand of money or gold as money would go down, gold would flow out and would go into the non-gold market. So in some sense, the supply is not or was never rigid, not even of the base of the pyramid. Even in the case of the very gold, of the shiny metal, the gold supply, the monetary gold supply would change with a kind of arbitrage between the non-monetary and the monetary gold market. So what about Bitcoin? Well, Bitcoin doesn't have a parallel market. It's just Bitcoin supply and it's limited, and the supply cannot go down and it cannot go up. And in fact, as George mentioned, that adds a lot of volatility to the currency of the value, because all changes in demand of Bitcoin will have to be reflected in the price of Bitcoin, because the supply of Bitcoin is rigid. And I think that rigidity in the supply is not really the case in gold. So we have a lot of troubles with scaling, and the costs go up as a result, because you can only handle so many transactions. So the cost of every transaction will go up and has gone up. And these are the fees that people pay nowadays to nodes or miners to handle and fulfill their transactions. And we're talking about more or less $9, but we also see that the fees have shot up to $34 or even over $30 per transaction, which is pretty high and very on an equal footing to the traditional banking system. But that's not all, because miners also earn money by mining, and by mining they maintain the ledger on which Bitcoin is based. And as soon as the supply of Bitcoin does not increase anymore, it will imply that miners will have to increase fees to have the same amount of revenues. And to maintain the same amount of revenues, they would have to raise, as a result, transaction fees to fees anywhere near $100, $150, $200 per transaction, which is a lot of money when we're talking about buying a pizza and about buying a cup of coffee. So if we look at gold as the base of the pyramid and the cost that's involved with moving gold physically, well, we've seen this example with Germany repatriating gold from New York from Fort Knox, and it cost about 7 million euros. Well, 7 million euros and $300, for instance, in transaction fees. Well, it's a big difference, still very economical. But with small daily transactions, it's completely not economical, and it's not clear who will bear the cost of those transactions. Is it the merchant who is able to charge a higher fee to Salvadoran buyers, or is the merchant obliged to assume those costs, which would be completely ridiculous? So, of course, that's not what happens, because what they're exchanging currently in Salvador is not really Bitcoins. What they're exchanging are IOUs to Bitcoins on a thing called Lightning Network, which is a second layer solution. Why a second layer solution? Because you have an ultimate settlement on the Bitcoin blockchain. Let's say I open a payment channel with George, and we do a few payments for a few weeks. Then we net out the payments on our own side ledger. We net out the payments and do a final settlement on the Bitcoin blockchain. But that means that the Bitcoin blockchain, which is pretty secure, doesn't scale to that very Lightning Network. Any transaction that crosses the second layer solution, Lightning Network, which is used in El Salvador, is not going to be as secure, and in fact is very susceptible to a very subject to hacking and to robbery, etc. And people act as if they're exchanging Bitcoin when they're actually not exchanging Bitcoin, with a higher level of risk than they probably are currently aware of. So in some sense, what they're currently doing is Bitcoin in itself is unscalable and non-viable. Unscalable in the sense of transaction costs and the number of the volume of transactions that can be handled. In El Salvador, they're not really talking about exchanging Bitcoins, but IOUs on Bitcoins, which are later settled on the Bitcoin blockchain. And as a result, the law never talks about this. The law only talks about Bitcoin. They never talk about derivatives or second layer solutions on top of Bitcoin. And I think the law therefore shows a complete lack of understanding of what they're actually implementing. So courts will have to resolve this in a very spontaneous way, or new legislation is likely or coming. So I think the legal tender, and that's my conclusion in this case, is trying to monopolize a first mover. We have competition between cryptocurrencies, and it's completely valid, also according to this Hayekian perspective, to have currency competition and to let people, users, decide which currency they would want to use because of the benefits that every currency conveys. But if we take a first mover, which might not be the final solution to all our monetary headaches, is very much akin to stifling innovation, to limiting innovation, instead of promoting innovation, which is more or less the perspective that El Salvador is giving. So I think the law is actually coming from a very opportunistic way of the president of El Salvador to try to attract foreign investment of the novo rich, of the new Bitcoin millionaires that have earned millions of dollars with appreciating Bitcoin, and that might be lured in by the president with this promise and this law to come to El Salvador, take their money, their recently earned money, and spend it in El Salvador. I think that is the real intention of the law, and I would very much oppose against any legal tender laws or compulsory tender laws, as George said, and I would very much like open competition between currencies in El Salvador. So thank you very much, and let's have a discussion. So let's see if there's questions by the audiences. I would like to ask you, George, just to start right off. We have talked about legal tender laws and compulsory tender laws. In many countries, in some way, legal tender laws conflict with the freedom of contract. So depending on the country, freedom of contract gets prioritized over actually legal tender laws. And I'm not sure how the case would be in El Salvador, but could you briefly comment on that?
Yes. Legal tender laws that of the sort I was describing, that are not compulsory tender laws in the sense that they only apply to debts, they come in a lot of different versions. And some of them are more strict and interfere more with contracts than others. But for example, I could have a contract to deliver a certain number of cows to you in a year, right? I owe you a debt, but it's in cows. I'm supposed to give you some cows. Let's say I borrowed some cows and I'm supposed to give them back, and I don't, right? Well, under a common version of a legal tender law, I might only be obliged to give you the dollar, or what the courts consider the dollar equivalent, and I would have extinguished the debt. Now, often there are very practical reasons for that. Sometimes it's just not practical for you to try to get cows from me because I just don't have any cows. Maybe I'm an artist who was supposed to make a painting for you, and I never painted the painting. What are you going to do? Make me paint a painting? So I owe you dollars. So, there's a fine line, but there are a lot of cases where contracts can't be enforced. There's no way to compel people to enforce payment as it was originally specified in the contract. And legal tender is a simple way to resolve what to do. And that's not so obnoxious, even though, in a sense, it's not abiding by the original contractual stipulations. So I don't want to defend all manner of legal tender laws, again, here referring only to those that affect outstanding debts. But I do want to suggest that while legal tender laws are never really necessary, there are countries that basically don't have them. Scotland doesn't have legal tender except for small amounts. While I don't want to defend legal tender laws in the sense of them being necessary, I will say that they can have a perfectly legitimate use in simplifying the way in which courts resolve unpaid debts. So I don't think that completely covers the question, but I would say that we shouldn't be too quick to consider legal tender laws nasty things. Often they aren't really nasty at all.
Okay, so let's go on to the questions of the audience. I have a question by Jamilet Valdez on Facebook, and the question is, what could people do to avoid the volatility of Bitcoin if obligated to use the currency?
Is that for me, Olev?
Yeah, sure. Go ahead.
Yeah, well, as I say, according to the present provisions of the Bitcoin law, they have the right and the ability, they will have the right, as well as the ability, to demand conversion of their Bitcoin immediately or with a short delay into dollars arranged by the Salvadoran government. The Salvadoran government will guarantee that they get paid what they would have gotten paid if they'd been paid in dollars to begin with. And the Salvadoran government will assume the risk of this conversion. And that's all well and good so far as the merchants are concerned. It means that they really are protected if this all works the way it's supposed to. By the way, there have been already rumblings about the law not necessarily always doing what it says it will do most of the time. And I fear that we could see occasions in the future when the government says, oops, we're not able to convert right now, sorry. Anyway, as long as they are offering to do that, the merchants are protected, but others bear the risk. As I said before, the risk doesn't disappear. There's no abstract government that assumes the risk. Some people in El Salvador have to assume it, and that means ordinary citizens who might find themselves having to fork over more money in taxes or otherwise to replenish the fund that covers losses suffered by the Casa del Cambio. That's where the risk is going to be.
Yeah, we actually, to also add to your story, I absolutely agree. We had close contacts with a Bitcoin payment provider. I had a company selling gold bars, and gold, but we had a high transaction value. People would typically spend like $35,000-$40,000 in a single transaction. And we looked at the possibilities 5 years ago to accepting Bitcoin. And we worked the case out with a Bitcoin payment provider. And in some way, we would accept Bitcoin on our website, then they would convert it into dollars, and we would get the dollar equivalent deposited on our bank account the next day. However, in that conversion, you have a time where actually you have a exchange rate risk. So if in the time that you do the conversion, the exchange rate shoots up or goes down, it could generate huge losses in the conversion, or huge gains anyway. But assuming the bad scenario, huge losses, the question came to the question that really mattered was, who bears the losses in those cases when you have these huge exchange losses? And they would say, well, you basically suffer the risk as a merchant. So we couldn't accept Bitcoin because of this very matter. And in this case, specific case, El Salvador, the Salvadoran government says, well, we'll take the risk, but of course with taxpayer money. So if things go south, if things go bad, it's actually the Salvadoran taxpayer, as you said, who will bear the cost of that public policy.
That's right. And a lot of those taxpayers are going to be even poorer than the merchants who are accepting Bitcoin, who are protected.
That's a very interesting point. So let's go to another question. I have a question by Juan Miguel.
I think have you frozen, Olaf? I have a frozen and I have a mute. I think you're muted, Adrian.
Yeah, so for some reason, my internet just failed for a second. Well, we have another question by Juan Miguel Arrastoya on YouTube, George. This one is for you. Gresham's law says bad money drives up good money. Is it possible people won't use Bitcoin to pay anything and they rather use dollars? What money is better money? Or what I think the question is what money would be the bad money in the case of having US dollars as well as Bitcoin as legal tender?
Oh my goodness. You know, I've written quite a lot about Gresham's law, including some very long articles. And it isn't a simple question of bad money or worse money driving out better money. That tendency actually applies when two monies are treated artificially as equivalents by law or otherwise. And then you get the tendency where, for example, to go back to our legal tender laws, if the law says that I can either give you 100 gold dollars or 100 paper dollars that aren't convertible and they're probably going to be worth less, I'm going to pay the paper dollars. That would be an example of Gresham's law, but notice that it's driven by the fact that somewhere someone is saying these two things that are really different are legally the same or equivalent, you see. In a truly free currency market, a Hayekian currency market, where, for example, people can choose either to receive and pay in Bitcoin or in dollars. So now we have two very different currencies, but nobody's saying they have to be both treated as equivalent. And people choose. If there's a tendency at all, it's for people to choose a better money. Now, better in this case could just mean it's more popular, because with money, popularity is a very important feature. The more people who you know will take it, the more likely you'll want to use it. So popularity could be driving things, and that's why dollars are popular, are a preferred currency, even though they depreciate. And Bitcoin is not a preferred currency, even though it can and is tended to, in the long run, appreciate. So in a free market, though, the point is Gresham's law is not what's driving things. Now, of course, in El Salvador, we don't have a free market coming up. We have a case where people are being forced to use Bitcoin, but that's also not exactly a Gresham's law case. Here it's a simple matter of legislation saying you've got to accept this stuff as money whether you want to or not. So it's not the subtle working of Gresham's law that's in effect making what might be considered bad money take over. It's something much less subtle. It's the government saying, use this or else. So it's Gresham's law is a special case of governments doing something that leads in an inadvertent way to bad money taking over. But it doesn't happen in a free market, and it's not exactly what's going to be happening in El Salvador either.
Yeah, I think if you if you want to read about Gresham's law, you can Google, I think, George Gresham's law. You can come up with all the type of blogs that George has written on the subject. Yeah. I think, according to your theory, I guess Gresham's law would exist if the Salvadoran government would fix an exchange rate between Bitcoin and the US dollar. No, that would probably undervalue and overvalue one of both.
Yes, absolutely. If they tried to do that, you could be sure that there would be situations where one or the other currency is being legally overvalued, and that's the one that people would tend to use. It's in one of my articles, or I guess in two of them, I use a simple game theory to illustrate the point. You have somebody selling a bottle of wine, and the government says that he has to take either the crummy coins or the good coins. They both have the same denomination, the same nominal value, but they're not really equally good. And he can't discriminate. He has to charge the same price for either one, and the buyer can't ask for a different price. Well, you're going to get an equilibrium there where the merchant's going to say, okay, I'm not going to price my bottles as if I'm going to get good money, because if I get bad money, I'm getting less real worth than I wanted. So I better protect myself, and I'll charge a bad money price. And the buyer's going to come in and say, well, probably this guy's charging the bad money price. I'd be a fool to pay the good money for the bottle of wine. So you get an equilibrium. That's the Gresham's law, bad money equilibrium. Change it to a free market where the merchant and the buyer can communicate and charge whatever price is appropriate for whatever money is offered, and that equilibrium will not prevail. There's no reason why it should. Probably the equilibrium with the nice money is more likely to prevail in that case because it's easier to deal with, more convenient, so on. Anyway, a brief lesson in Gresham's law.
That's a good thing for our students. So we have another question by Alessandra Spiari on Facebook. And this is more about countries with a less stable currency. I mean, Salvador has the US dollar, but in this case, she mentions Argentina. Despite the value of Bitcoin being so unstable, do you think that countries like Argentina that are rapidly losing the value of their currency due to inflation would ever change to Bitcoins?
My answer to that is that, first of all, I think it's very valuable for people to have the option of switching to Bitcoin and for them not to be penalized. And so, as I said, level playing field legislation, I think, is very, very desirable. And for many purposes, Bitcoin is the best means of escape from oppressive government policies. But that's mostly with regard to exchange controls and such. When it comes to having a bad domestic currency, like one that's rapidly depreciating in Argentina, or maybe a better example is Venezuela right now, and for some time. Frankly, the answer is that Bitcoin is rather late. It's a few steps behind some other currencies that are much more likely to be spontaneously adopted where people have a choice. The dollar is first in line. The first lifeboat people want to jump into is the US dollar. Why? Because it's the best currency in the world? Well, yes, but only for one reason. It's extremely widely accepted. It has a market that exceeds all the others. And if we go back to Carl Menger, who has the famous theory of what it takes for something to become money, it's all about salability or marketability. And a good that captures the most, that is most widely accepted, is going to be most attractive to others who are looking for what good they should use as their medium of exchange. And this is a compounding situation. So dollars are the first choice. Bitcoin would be way down there. I mean, several steps away. So I think that honestly, in practice, if people can choose between A, their domestic currency, B, the US dollar, and C, Bitcoin, where the domestic currency is rapidly losing value and Bitcoin and the dollar are both as they are right now, the dollar is going to be the vast majority of people's choice, not Bitcoin. Bitcoin is a popular investment asset. It's popular for certain kinds of transactions where pseudonymity is valuable. It's popular for many reasons, but it is not popular as an ordinary medium of exchange. And that's why I don't think it's the one people would want to switch to. They should be able to. The law should make it possible. But that doesn't mean that it's what most people are going to switch to.
And if we think about, just adding to what you just said, if we think about Venezuela as in the sense of capital controls, where Venezuelan citizens are unable to exchange their domestic currency, bolivares, for US dollars, for instance, they can use Bitcoin, of course, to get perhaps money out of the country. But even if they manage through Bitcoin to get money out of the country, probably they would be converting that money or those Bitcoins into dollars
Yes, that's
ultimately.
right.
So is Bitcoin then a method of payment or method of transfer?
Yes.
Or currency, or how do you view this? Can a currency that is just a method of transfer be a real currency?
Well, let's distinguish between a medium of exchange and money, right? Something can be a medium of exchange. That is, it's used for certain exchanges, but it's not money, which economists define as a generally accepted medium of exchange. It is something that's used for most ordinary payments. Now, there's no, that's one of those loose definitions, admittedly, but it's pretty clear that in Venezuela right now, the dollars are more widely used for ordinary exchanges. Once people can get hold of them, than Bitcoin. Bitcoin is a specialized medium of exchange, not a generally used or accepted medium of exchange, hence not money. Could it become money somewhere, even without a law that forces people to accept it? Yes, it's possible. It's possible, but it's not that likely. And I want to emphasize here something very important. The fact that Bitcoin's value has gone up, that its market capitalization is very high, that many people, including very serious banks and even central banks, are treating it as an important investment or financial asset, that doesn't mean that it's becoming money. That doesn't mean that anywhere it's widely used for ordinary payments. That really hasn't been happening, and people confuse the two things. They confuse the fact that Bitcoin has become important in certain serious respects with its becoming money, and they aren't the same.
Then, in fact, we could probably argue that as the price goes up, right, as Bitcoin is a speculative asset, the price goes up. Actually, its function as money is diminished because its value is clearly unstable and
Absolutely.
unpredictable.
Yeah.
So,
One of the ironies, if I may expand on that very briefly,
sure.
is that I often encounter Bitcoin fans who insist that, of course, it's going to become money. Of course, we're going to have a Bitcoin standard, et cetera, who are also hodlers, who believe in holding Bitcoin, not spending it. Well, there's a certain tension there, because if everybody agrees that Bitcoin is something worth holding as an investment, then they're going to spend something else. That's not exactly Gresham's law, but it leads to the similar result that the thing you really want to hold on to because you think it's an appreciating asset is not less likely to become the first thing you offer in exchange for other stuff.
Right. And if people demanded to hold it, what we call in stock markets free float, no? The supply that circulates, the supply that changes hands is getting less and less, and therefore the volatility doesn't get better or less, but it gets worse. It gets higher. So in
Yes,
a
because
sense,
you have a limited supply. So
right.
the good news is that the more people who hold on to this stuff, the more it appreciates, the more money they make. And that's why hodlers want everybody to be hodlers. The bad news is it's not being used to buy stuff. If everyone's accumulating, therefore it ain't becoming money.
Right. We have 1 minute left, George. I'm going to ask you the last question, which is a very fundamental question, but I'm going to put it out there. It's a question by Luis Pedro Insua in Facebook. Do you think Bitcoin will at some point unseat the US dollar as the main reserve currency around the world? I can guess your answer, but please, in 1 minute, give us a summary of today.
Well, the answer takes less than a minute. It's no, mostly for reasons I've given. But I will also say that I don't think the dollar's being threatened by the Chinese yuan, which people are talking about that. The dollar's place as a supreme popular medium of exchange is actually very strong now, despite everything, despite all of the problems, despite the fact that there's Bitcoin, despite crises, etc. The fact is that, if anything, all these crises have boosted the demand for dollars. Dollars have proven to be the thing people want to rush into when everything else is going south. So I don't think the dollar's hegemony is really under any threat. That doesn't mean that it's guaranteed to last forever. History warns us against that kind of hubris. But it does mean that right now, there's no serious rival out there, and Bitcoin certainly isn't it. Yes, central banks are adding Bitcoin to their portfolio, as are major firms, and so on. But the treatment of something as a reserve currency by central banks isn't quite the same thing as it's being the dominant medium of exchange for international trade and that sort of thing. There, the dollar, I think, remains firmly in place.
Okay, thank you very much, George. It was an absolute pleasure. You're always welcome to visit us as well in Guatemala. You know, we're very fond of you.
Thanks.
Okay, well, on behalf of the... Sorry?
A pleasure for me as well.
Great. Well, so on behalf of the Centro Henry Hazlitt at Universidad Francisco Marroquín, I thank you all for attending this conference. Please join us also next week. It won't be me, but somebody else to discuss freedom of speech and expression in the conference, ¿Quién es más libre, J Balvin or Queen? And in that event, we will discuss if music is an expression of free speech, how capitalism has allowed for more people to enjoy music, and a discussion between different genres. So again, thank you very much for your attention. Good afternoon, and hope to see you all soon.
Bye, everybody. Thank you.
Hoy, el mundo busca cursos en línea. Hoy, el mundo sigue las tendencias del mercado. Hoy, el mundo necesita emprendedores. Hoy más que nunca, el conocimiento se dispersó y la Universidad Francisco Marroquín no cerró. Se multiplicó en diversos hogares.